Welcome back to our intermediate financial accounting class. In our last segment, we started talking about the adjustments that have to be made to retained earnings because of four very distinct changes that occur in our financial records. Changes in estimate, changes in principal, changes in entity, and then changes because we have to fix errors or the correction of errors. We didn't get a chance to talk about all of those because we only had a few minutes in that segment, but we did start talking about a change in estimate, what it is, why it's important, and then we took a look at an example. And I invited you to go through and work that example on your own before coming back and watching this segment. So hopefully you looked at Stateco's information and you did your calculation. And now that you've had a chance to try it, we're going to walk through it together. And the best way to do this is to look at the allowance for bad debt expense. We started off the year, we were told, with $15,000 in the account. Since it's an allowance, it's got a credit balance. The next thing we were told is that we wrote off $22,000, so that's a debit to allowance for bad debt, a credit to accounts receivable Bob Smith or John Smith or Jane Doe or whoever. We write off their accounts, they're not going to pay us. The next thing we need to figure out is what debt expense is. If we're using the percentage of accounts receivable method, we'd figure out an ending balance, and then we'd figure out what we needed as our journal entry to get to that ending balance. But we're not doing that. Instead, we're doing the percent of sales method. So we figure out our expense, and then that tells us what our ending balance will have to be. So under this method, we take our credit sales, and we multiply by our percentage. In the past, that's been 2%, but the management team has decided that's not accurate enough, times are hard, so we're going to bump it up to 5%. And that's the only adjustment I'm going to make for this change in estimate, is to just change the percentage I use in this calculation. So 550 times 5% is 27,500. That number is going to go up here. And if I take 15 minus 22 plus 27,500, I end up with a balance of 2,500. And that's what the question asked for. But because we love journal entries, we might as well do the journal entry. I'm sure you did it yourself anyway. Just for the fun. This is an adjusting entry for bad debt or credit sales or people ripping us off, however you want to say it. Now, I also give you information about last year's credit sales. We had $600,000 worth of credit sales last year. We don't care at all about that number because this is a change in estimate. I used the 2% in good faith. It worked well for a long time. Now I've decided 5% is better. But since I made my estimates in good faith, I don't have to make any changes to what I've done in the past. I just use the new numbers moving forward. And that's all there is to it. Please keep in mind, as you do these changes in estimate, that it does affect retained earnings. I mean, this looks like, no, it's just going to affect bad debt expense and this allowance. There's no retained earnings effect. Well, there is, because bad debt expense is going to go up, which leads to a drop in net income, which leads to a drop in retained earnings. So it's not an explicit change to our statement of retained earnings or the retained earnings account, but it's going to flow through retained earnings as part of our net income calculation and our closing entries. Now that we've talked about changes in estimate, it's time to move on to the next type of change, and that's a change in accounting principle. A change in accounting principle is the formal title for a change in method, and we use a lot of methods in accounting because we're doing accruals and not just cash flow. So the flow of inventory is typically based on some kind of an assumption. I mean, unless you're making yachts or large construction projects and you can track each item you make specifically, everything just becomes a hodgepodge and you have to come up with a method to sort of keep track kind of when things might be sold because they can't keep track of each item as it comes in or out. So I use LIFO, FIFO, weighted average. All of those methods are options that a company can pick from. The bad debt estimation methods, like the one we just did, that's a method. The present value amortization methods for bond premiums and discounts, etc. That's a method. And these methods can change. They can change because the company decides that the method they're using doesn't really accurately reflect what we're doing. And it can change because FASB has simply changed the method in a vote. And that happens more often than we think as GAAP actually changes. I didn't realize how often changes in principle really occurred, because to me, it was something that maybe sometimes kind of happened, but not very often, because companies couldn't really justify to investors, hey, we're going to switch double declining balance. No, we're going to switch back to straight line. No, we're going to switch to units of production. How do you convince people that you're doing that for legitimate reasons and not just to make your income numbers look better? Well, it turns out that companies do sometimes make changes. And if they do, they have to logically justify it in their footnotes. We did this because of X, Y, and Z, and they're good reasons. And we've talked with the auditors and they agree this is really more accurate, so we're going to do it. But what happens more often is this other possibility where FASB simply changes the method on you. And I didn't realize how pervasive that was until I started getting a newsletter from the AICPA, which you can sign up for, and they send out once a day or once a week. Here's the headlines in accounting. FASB's doing stuff all the time, as is the IASB and the PCAOB, etc. E&Y and the other big four, they also publish newsletters that allow people to keep track of what's changing in the profession, and that includes what FASB's doing. This might be something to look into so that you can keep track of what FASB's messing around with, for lack of a better term. But it changes a lot. Matter of fact, in the last year, there have been at least 4 major changes that have had to be incorporated into my lectures and my discussions with students and in fact into this very class because of what FASB's done. So it really is most common to see a change in principle when FASB makes you change principle. And it becomes a really big deal for companies when they do that. Now, one of the things that FASB did do, realizing that there are a lot of different changes in here, is they looked at some methods and said, you know, these methods are pretty much estimates. So even a change in method itself, we're going to treat like a change in estimate. The bad debt estimation methods, the depreciation methods, those are both prime examples of changes in method that FASB has said, you know what, don't treat them like a change in principle. The method itself is an estimate, treat it like an estimate, which means I can just use the new numbers moving forward and not have to worry about it. The reason FASB's done that is because a change in principle is a rather intense process. It's very fun because of all the neat accounting that goes on, but it is rather labor intensive. If you have the information, you have to use what we call the retrospective approach. And this is what FASB recommends. If you don't have the information, then they do provide a couple of shortcuts or alternatives, but they want you to use what we call the retrospective approach. And that retrospective approach means you go back as far as you can with the records that you have, and you fix everything moving forward, as if you'd use that new method from the very beginning. You change it all. And that becomes a rather intense process to change everything from the beginning of your records to the current time. The good news about that is it keeps companies from making changes without a really good reason. It also has made FASB change some of these rules on certain methods that do get changed relatively frequently because they don't want it to be too burdensome. The bad news is that it also makes companies really reticent to accept FASB's pronouncements. And a lot of the fight against changes in GAAP are because companies don't want to have to make these kind of big changes. I know with the new revenue recognition standards, companies prepared for years to get ready for that change. The lease standards that they talked about changing for 18 months or more. Big accounting departments, the big four firms, the regional firms, et cetera, spent lots of man hours getting ready for what this change could possibly do if it came through, because we're going to have to be ready to go back and make these retrospective changes. So it's a big deal to implement a change in principle. Let's take a look at what has to be included in this change. We're going to change and update all of our financial numbers. So all of the numbers that we present to our investors have to be changed. And the key term here is this word reported. So I have to change any financial statement I include in my 10K or in my report to the bank to include the new principle. So most of the time as we've worked on financial statements, we've just looked at the current year, but typically you have to report at least this year and last year for comparison purposes. So when you change principle, you're going back and calculating numbers from the beginning as far back as you can. And then you're literally changing the financial statements to show those new numbers for all the financial statements you're going to present to your investors or to your stakeholders, whoever they happen to be. Now, there's a lot of options here. Banks sometimes will want 3 or 4 years worth of data. An angel investor or new parent company might want 10 years of data. That's up to them. The SEC, kind of a baseline, requires multiple years for every financial statement. So in an SEC required 10K, you must report 3 years worth of income statements. This year, last year, and the year before that. You also have to include this year's balance sheet and last year's balance sheet. And you have to include this year's statement of cash flows, last year's statement of cash flows, and the year before. And all of those statements, now we're talking about 8 financial statements, have to be updated to report the new numbers. So that's the reporting consequence of a change in principle. In addition, the footnotes require some extensive disclosures. So you have to include at least the following. First, you discuss if it's really a change in principle or if it's one of those changes in principle that's treated as a change in estimate. So we've just done a little change in estimate tweak. You also have to talk about what numbers in the prior period financial statements have been changed. We also have to show the effect on specific key indicators: net income, income from continuing operations, total assets, earnings per share, and any other really important values for your investors. And finally, we show the cumulative effect on retained earnings for the earliest period presented. So on the balance sheet, I'm going to show the new retained earnings number. Statement of retained earnings, show the new retained earnings number. In the footnotes, I'm going to describe how I got to that new number and what rolled in to getting us to that new value. Well, let's take a look at how we actually do this. And we're going to break it down, as always, into steps. And if you can be comfortable with the steps, you'll be good to go. Step number 1, we're going to calculate the affected account balances using the new method. So if I'm changing from FIFO to LIFO, then I'm going to go back and recalculate inventory and cost of goods sold for all of these previous years and the current year. Once I've got those numbers done, then I can move on to step 2 and calculate the change to retained earnings using the updated numbers. So really, I'm looking at the change in the expenses and revenues that would have been caused by this new method. Third, I'm going to change the financial statements so that they match the updated numbers. These aren't because of journal entries. We'll get to the journal entries later. That's step 4. In step 3, I'm just changing the numbers from what I reported to you in the past to what they should be under the new method. Finally, once I've got the financial statements balanced, I've got all of these calculations done, then I get to make a journal entry that adjusts the beginning balance of retained earnings and the other permanent accounts in the year. I'm not going to worry about expenses and revenues. I'm just going to worry about the permanent accounts. As you can probably tell from these steps, this retrospective approach requires a lot of data and a lot of work. We're literally going back and redoing years worth of accounting to make this happen. Because of that, it's very accurate. It's also very time consuming. It's job security. And it's also one of our key concepts, understanding what this retrospective approach is and how much it really does change and affect our financials. When we come back in our next segment, we're going to move on from talking about it to doing it. We'll see you then.